Hello everyone. Let me take you through the debt outlook for this month, starting with the US market. Market participants were anticipating Fed to pivot given higher rates will lead to lower growth. However, inflation and jobs data in US continues to be strong. US inflation for the month of September 22 came in at 8.2%, continues to be higher, dashing hope of any Fed pivot anytime soon. We had an FOMC meeting on 2nd November 22. Fed target range was hiked by 75 basis points to 4%, and Fed indicated that future quantum of rate hikes might be lower, but continuous increase in rates is prudent and rates may continue to remain higher for a longer period of time in order to bring down inflation to 2%. Hence, it will be fair to assume that Fed target range might be hiked to 4.75% by March 2023. Currently, US 2-year bonds are trading at 470, pricing in a terminal rate of 4.75 to 5%. However, the 10-year bond and longer maturity bonds are trading sub 4 quarter, indicating a shallow interest rate cycle. Now, given the global backdrop, let me take you through the Indian macro and rate outlook. Given the turmoil in the world market, global currencies have depreciated against the USD. Indian rupee, even though a relatively better performer, has seen a depreciating trend in the month of October 22, depreciating from 8150 to 8280 levels. Inflation for the month of September 22 came in at 740 as against 710 for the previous month. It seems inflation in India is peaked and is likely to gradually trend lower and likely to come within the RBI target range of 2 to 6% by Q1 FY24. The MPC minutes of the September 22 policy meeting were released in October 22. Dr. Ashima Goel had voted only for 35 bips hike, and in a separate interview, she indicated that 100 bips real rates would be appropriate. Professor Jayant Verma's assessment was that post September 22 policy, the MPC should pause on rate hikes and take stocks. Overnight rates have been increased by approximately 280 basis points from 335 levels in April 22 to 6.15% in October 22. Given the Fed rate hike, we expect the repo rate hike of 35 basis points in the December 22 MPC. At this stage, we believe our terminal repo rate shall be closer to 6.5%. 1-year OIS is currently trading at 7%, discounting overnight rates increasing to 7% by March-April 23, approximately 100 basis points higher from the current levels. We prefer 2 to 6 year segment of the curve, as a 2 to 6 year GSEC is currently trading in the band of 720 to 760, and it seems to be discounting a terminal rate of 6.5 to 6.75. We may look to increase durations of our product gradually from here till March 23 as we are approaching the terminal rate in this hiking cycle. Investors with 18 months to 2-year investment horizon can look to gradually increase duration of their investment portfolio and can consider investing in targeted maturity funds or actively manage duration dynamic funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.